Make your retirement savings immune from taxes, inflation, and market volatility. Now, in this educational episode, I'm going to teach you that money has to have a home, okay? And there are three general houses that most Americans park their money. I'm going to show you how to participate in all three of those and not be at risk of losing when the stock market crashes or the real estate market crashes by keeping your money safely tucked in another house, so to speak. So get ready. So I'm Doug Andrew, and I've been helping people accomplish their financial goals now for 5 decades. My favorite financial vehicle, bar none, is a properly structured, maximum funded, indexed, universal life insurance laser fund. Now, a laser fund is an IUL, indexed universal life policy, that is structured correctly and funded properly. And sadly, I would say that 99.9% of IUL policies sold in America are not structured to do what I'm going to show you here. So don't judge it if you've never seen one, perform like I'm going to show you here. But this is a very powerful concept or strategy that has allowed me to help thousands of people not outlive their money. So let's talk about a metaphor that I came up with years ago using the story of the 3 little pigs. Now, if you remember, there were 3 houses. One of the pigs built a house made out of sticks, okay? Now, I would equate that to moderate risk, maybe the real estate market, because the big bad wolf doesn't blow down the real estate market usually in one day, whereas the stock market can lose several points, 15 to 20 points sometimes in one single day, or 30% in a month like March of 2020, COVID-19, or 2008 in 1 year it dropped 40%. Whereas real estate, there's a lag, okay? But that brings up the house of straw. So I equate the stock market, mutual funds and what have you, money in the volatile market as the house of straw. And so that's because the big bad wolf blows down the house of straw pretty easy. And we see that just with things that happen in America, shootings, riots, whatever, and all of a sudden, bam, the domino effect happens, and within 48 hours, the stock market reacts. That's because your money is in this volatile position based upon emotion and things out of your control. So there's a third kind of house, and that's where I prefer to keep my serious cash, and this is, of course, the house of bricks. Now, we could have several safe repositories, but if you read any of my books or watch very many of these educational videos, I'm big on the key elements of a prudent investment. And the number one key element of a prudent investment is liquidity. Having access to your money when you need it, okay? Too many advisors, they put that down the list 3 or 4. No, liquidity. Lack of liquidity is what gets most Americans into trouble when we have crashes or recessions. So liquidity is the number one pillar that I talk about here. Number 2 is safety. Not only safety of the institution, but safety of principal. Whatever I set aside, I don't want to lose. But any year I make money, I want that money I made last year to become newly protected principal, meaning I don't want to lose in future years money I made in previous years. You wouldn't believe how many advisors don't know how to do that. And this is a concept called lock-in and reset that I explain in my book that I want to gift you at the end of this episode, so stay with me here. And so then we get to rate of return. Well, when we start talking about banks, money market accounts, CDs, and what have you, rate of return isn't that great. The banks are crediting, 1%, 2%, 3%, maybe 4%. But you know that the current of inflation is coming down at 9, 10, 12, 15. You're going backwards. So I want my money in a house of bricks to outpace inflation, not lag behind it. And so I rule out money market accounts, CDs, bonds, even many annuities. What's an annuity? It's a savings account with an insurance company. Now, it passes the safety test. Rate of return is pretty good, but annuities are only tax deferred. And then when you start taking out money, then they're taxable, LIFO, last in, first out. I prefer, if I can qualify for an insurance contract, or if I can have my spouse or my adult children, I prefer a maximum funded insurance contract. It knocks the socks off of most annuities to accommodate your foundational tax-free plan. I recommend that 40 to 60% of your income in retirement be totally tax-free. Not even show up on the front page of your 1040 tax return. And some people say, is that legit? Absolutely. It's been a protected asset, tax-free in the Internal Revenue Code now for 108 years under 3 sections of the code. What are those sections? 72E, 7702, and 101A. You can learn about them in the book. But my point is this. I prefer to optimize my assets for long-term goals over here in a house of bricks in insurance contracts because they knock the socks off of tax-deferred IRAs or 401ks invested over here in the market. If you haven't figured this out, Wall Street was never designed to create predictable income. In fact, the financial services industry, they only want you to pull out 4% a year. It's called the 4% rule. And that's because, Dalbar, who studies investor behavior, they found out that most Americans, if they would buy and hold instead of panicking and getting involved in emotion when the market starts to drop 15 and 20%. See, most Americans, when the market goes down 15, 20, 25%, they go, they panic. Enough already. Emotion takes over and they sell. Okay, they sell low. And then they wait until the market is rebounded, and then they buy high, and they're missing out, see? And they said, if you followed Warren Buffett's advice, buy and hold, you'd probably average 9.14%. Well, let's say you could do that. If you're averaging 9%, that's before tax. In a 33% tax bracket, which most savers are in when they retire, and taxes are going up, by the way, you're not netting 9, you're netting 6. So on $1 million nest egg, if you pulled out 9% or 90,000 so as to not deplete your principal, you pay tax of 30 grand and you have a net of 60,000 or 5,000 a month to buy gas and groceries. Maybe you can tighten your belt to do that. But Dalbar found this out. The average American, they're only earning 3.49% with their money in IRAs or 401ks in the market. Why? Because they're buying and selling at the wrong time. So the actual return is 3.5%. This is what precipitated the 4% rule in the financial services industry. Broker-dealers don't want their asset managers to illustrate any more than a 4% payout. That means $1 million nest egg, they only want you to take 40 grand without you signing hold harmless agreements and everything because they don't want to be sued for you outliving your money. So they just say, just show them 4%. That's unacceptable to me. That's pathetic. And they don't realize it's because Wall Street was never designed to create a predictable income. So your money should not be in the market when you retire. When people would come to me with their yet-to-be taxed IRAs or 401ks invested in the market, I'd go, what are you thinking? They're going to be taxed to death, and they're going to be subject to market volatility. And all of a sudden, the market goes down, and they're going to be tempted to hold off on income. Is that what you want to do in retirement, is worry about, can I afford to meet my financial obligations this month? No, that's not what you want. You can move over here to the house of bricks, and you can generate $80,000 a year instead of $40,000, but that $80,000 will be tax-free. You can generate $90,000 or $100,000 by diversifying and rebalancing. Now, if you could pull out 100 grand out of $1 million nest egg, and that's tax-free versus you only netting 30,000 after tax in a 25% bracket on a 4% payout, you pull out 40 grand, pay tax of 25%, you only have 30,000. How much more is 100 grand than 30? Or even 90,000? It's 300% more. Believe me, I have helped thousands of people triple or more their net spendable retirement income by simply repositioning assets over here to the house of bricks. How does it work in a nutshell? When I have an insurance contract, if I feel bearish about America, I just settle for the general account portfolio rate, which might be right now in a low interest environment as of the recording of this episode, 4 or 5%. On $1 million, I'll just settle for 40,000 or 50,000. But in a year, I feel bullish about America because 7 out of 10 years, the market will be up, okay? then you can link your returns to the things that are happening over here, okay? So let's say I have $1 million nest egg. It's earning 5%, that's 50 grand. Instead of taking the 50,000 of interest and crediting it, I relinquish that. I let the insurance company use the interest on my million, but my million has to stay safe over here. They use that 50 grand to buy upside options in the index or indices I chose, let's say the S&P 500. So they buy upside options. If the S&P goes up 8, they'll credit me 80,000 on my million. If it goes up 12, they'll credit me 120,000. Maybe up to a cap, but the trade-off is if I guess wrong, and guess what? The big bad wolf blows down the stock market, I can sleep when the wind blows because my money is not in the stock market. I may not make anything, but I don't lose. Those options expire worthless and I still have my million. This is called indexing. It is incredible. And you will usually, by using indexing, increase your rate of return 2 or 3 percentage points over the general account portfolio rate of the institution. The multi-trillion-dollar AAA rated insurance company is what I recommend. But by rebalancing and diversifying, I have pushed my gross rate of return up to over 11, netting over 10% tax-free cash on cash. Meaning the cost of the insurance and all fees only gobbled up about 1% of my gross rate of return throughout the life of my account, retroactive back to day one. I'd rather earn 11 and net 10 than have to earn 16 or 17% to net 10 in a tax-deferred IRA or 401k, and it's in a volatile market. Likewise, if you haven't connected the dots, when my real estate goes up in value, I benefit. But when it goes down in value, which it can do and has done, I've never lost a dime. Since the first lesson I learned in 1982, during any recession where my real estate, my house went down, including 2008, my house went down in value from $1.5 million down to $1.1 million. It went down 400 grand. I did not lose one dime because the 400 grand was not there. It was over here. And the interest I was earning was more than double what I needed to service the debt on the $400,000 second and third mortgage I had on my house. It was mortgaged to the hilt, 100% loan to value. So if you want to learn more about what I'm talking about here, the reason why you want to put your serious cash safely tucked over here in a house of bricks is to have it score the highest on these 4 pillars: liquidity, safety, rate of return, and tax benefits. A properly structured IUL laser fund scores 33, 35 out of a possible 40. Nothing else even comes close. Most people's money in America, here and here, is lucky to score 18 to 22 out of a possible 40 points on that scale. So folks, increase, optimize, improve your financial situation, and watch what happens. You will not outlive your money. It all starts with claiming your free copy of this book if you have not yet. Simply click on the link below or go to laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. It's 300 pages of charts, graphs, and explanations, and 62 actual client stories on this side of the book. It's actually 2 books in one, okay? But while you're in there claiming your copy, if you'd like to listen and learn or watch and learn, check out the audio and video educational formats, because I like to learn from all of those methods. You can join us for some educational webinars we do on a regular basis. They're free. But even more importantly, you can schedule an appointment to talk to an IUL certified professional that can show you how these strategies may apply in your particular set of circumstances. Once you learn the concepts, you're probably wondering, well, how does this apply to where I'm at financially with my assets? And they will create these illustrations to show you this with no cost or obligation. Is that fair enough? So take advantage of this now so that you can begin to reposition your serious cash over to the house of bricks and not be subject to the market volatility with the stock market or the real estate market.